Hello, my name is Paula White. That's my picture right here, and this is my name, Paula White. I am a CPA, and I have my MBA from Washington University, and I am your lecturer for Accounting 101, Week 1. First off, welcome. I just misspoke. It's welcome to your lecturer for Accounting 102, Week 1. First, I want to congratulate you for successfully passing Accounting 101. I know that was a big accomplishment. You covered a lot of information, and we'll do a quick review in the presentation today of what you covered, because accounting builds on itself. So you just laid the foundation, and we're going to put in the next layer of information in Accounting 102. This is a mega course formatted Accounting 102. That means some great things for you all. First, I'm just going to click on Live Session for the schedule, and these are always subject to change, but as you see, there are 1, 2, 3, 4, 5 sessions. You only have one instructor, right? Well, the great thing about it is there's 5 faculty members who are teaching this exact same course at the exact same time. So we have combined forces, and we're teaching in a team setting. What this means for you is that the first schedule of the week, which is the one I'm scheduled for, is the instructional session. Live instructional session, recorded, just like your other courses were. However, the other 4 instructors are going to have an hour session also. What they are doing is they are getting on the session instead of lecturing and spending the time again lecturing, saying pretty much the same thing as the lecturer is going to be saying, except in their own words. But as professional accountants, we kind of speak alike. So, and those other 4 sessions, or those other sessions, they're going to be to support you. So hop onto Zoom, hop onto those live sessions, and ask your questions. If you have a question about a homework, then they'll answer the question about the homework. They will not do your homework for you, but they will give you the information necessary to go yourself for the next step. This is in addition to, you still have your access to the tutoring center. We're not taking that away. We're just adding additional support through combining the lecture into one person's activity, and then the other faculty members will be supporting all the students taking 102. So you may be one of my students, so you have access to the other 4 faculty members. The people who are students in the other 4 faculty members have access to me doing the live session. So basically, in this mod, you're having 5 faculty members supporting you, which I think is pretty awesome. Also, let's go to the home page. And I'm going to go to week 1. Okay, so right here, under Course Home, you have Mega. Oops, of course it went to week 1, just like I told it to. Under Course Home, you have Mega Course Lecture Videos. Click onto that. and you have other lectures. These aren't the lectures that are the hour-long lectures that are recorded. These are mega lectures, and they are short. Let's look at you have week 1, Introduction to Flipping or Mega Courses. If you're concerned about what a mega course format is, then you have week 1's material lecture. You have material for week 2, material for week 3, and the lecture on material in week 4. And just to show you the material for this week is 11 minutes. So they're not huge they're not a huge payment in time for you to listen to. You can even listen to them over and over and over again to support reading the textbook. There's support to the faculty supported live sessions. It's a support to the tutoring center. It's a support to you. So use every bit of support that Stevens Henniger, IU, has provided to you to succeed in Accounting 102. So what else do I need to tell you? I think we're good. We're going to go over the homework requirements after the PowerPoint presentation. Okay. Week 1 in this mod is on Chapter 6, Closing Entries and the Post-Closing Trial Balance. Section 1 is about the closing entries. What the objectives are of this section is to journalize and post the closing entries. And this should look familiar to you from the lectures from Accounting 101, because from step 1 through step 6 was Accounting 101. Now we're going to go to step 7, which is post-closing trial balance entries. So let's just review what you learned in Accounting 101. Step 1, we analyzed transactions. That's when we had the business owner pulling money out of her personal savings, putting it into a business checking account in the name of the business. We were analyzing the situation of the transaction. We were analyzing which account will go up, which account will go down, identifying the accounts. And at this time, in step 1, that's where we were saying, well, the business cash would go up, and the owner's equity section, probably the capital account, would go up as well. Then in step 2, we journalized the data about the transactions. That's when we went to the general journal and put in the journal entry. We started with the date, and then we had the debit account. In this situation, where we would write cash in for the account title, and in the debit column we would put the amount. So cash, $50,000. The next line we would indent and put capital P White, if it was my capital P White, and it would be a credit of $50,000. Then underneath it we would put a reason as to why we're making this journal entry, and the reason would be to record owner's investment. So then step 3 would be posting the general journal in step 2, posting it into the general ledger. That's when we would find the actual T account in the general ledger for cash and put the date in and put the debit of $50,000 into the cash general ledger account. Then we go down to the capital-P White account, and we would put a credit in that account. So we're posting the journal entry into the general ledger in step 3. So in step 4, we prepared that worksheet that had, I believe, 10 columns. The first 2 columns are the trial balance. The second 2 are the adjusting entries to the trial balance. And the third set of 2 columns would be the adjusted trial balance. And then we also covered the fourth and fifth set of 2 columns. One was the income statement and one was the balance sheet. And then we prepared financial statements in step 5. And the financial statements, as you remember, are the income statement, statement of changes in retained earnings, and the balance sheet. And then the fourth one is the statement of cash flows, which we have not yet prepared. And then we journalized and posted the adjusting entries that we prepared in the worksheet. And now we're going to talk about journalizing and posting the closing entries. Prepare a post-closing trial balance, and then step 9 will be interpreting the financial information. So we've almost covered the entire accounting cycle. So the 7th step in the series is to journalize and post closing entries. We have a new account to deal with. It's called the income summary account. It's classified as a temporary owner's equity account. It only has 4 entries posted to it in the entire year, 3 entries putting balances into it, and the 4th entry taking the balances out of it. It's an income summary account. It's the loneliest account in the entire accounting system. It doesn't have a normal balance. As you will see soon, a debit gets put into it, a credit gets put into it, another debit. Whatever its balance is, the 4th entry zeroes it out. It doesn't have a normal balance. It's just a temporary account to summarize and move forward. It has a 0 balance after the closing process and remains with that same 0 balance until the end of the closing procedure for the next period. So for the entire year, except for perhaps 4 seconds, it has no activity in it. And then it has 3 transactions going in it and 1 transaction zeroing it out. So it is not used except for the very end of the accounting cycle. There are 4 steps in closing the process. 1, you transfer the balance of the revenue account to the income summary account. Let's just list them off and then we're going to show you how. Oops, I went the wrong way. The second step is to transfer the expense account balances to the income summary account. So at this stage, I hope you can see that in the revenue and expense section of our general ledger, that the revenue accounts individually have been debited for their balance, zeroing out each and every revenue account, and likewise each and every expense account have been debited in this process. Credited in this process to zero them out. Because expenses have a normal debit balance, you're going to credit to zero them out. Revenues have a normal balance of a credit, and you will debit them to zero them out. Now that both revenue and expense accounts those balances have been moved to the income summary account, the income summary account, its balance should be the exact same number that you have on your income statement. Now you're going to transfer the balance of the income summary account to the owner's equity account. And then you're going to transfer the balance of the drawing account directly into the owner's equity account. So basically the drawing account, the revenue accounts, and the expense accounts are all zeroed out in this process, and they're hard-coded into the capital account. So at the end of this process, at the end of these 4 entries, which accounts have balances in them now? It's only the asset, liability, and capital account that have balances in them at the end of the closing process. And those accounts, if you remember from week 1 of Accounting 101, they were called permanent accounts, and this is why. Even after closing, they'll still have the balance in them. They are permanent accounts. Where the revenue, expense, and drawing accounts were called nominal accounts, and those accounts are the ones that get zeroed out at the end of the year to prepare for the next year of activity. So, step 2, let's close expenses. Well, there's really the step 1. Let's continue on. Step 2, close expenses. The income statement section for the worksheet lists 5 expense accounts. Since the expense accounts have debit balances, you enter a credit in each of these accounts to reduce each account balance to 0. And then the entry transfers the total expenses to income summary. Step 1, just like this, I will read this to you as if it were step 1. Step 1, close revenue. The income statement section of the worksheet for Wells Consulting lists 1 revenue account. That was fees income. That's the only revenue account they had. Since revenue accounts have credit balances, enter a debit in each revenue account to reduce its balance to 0. And this closing entry transfers the total revenues to the income summary account. Now we get step 3, we get to closing net income into capital. The journal entry to transfer net income into owner's capital is a debit to income summary and a credit to Carolyn Wells capital. The balance of the income summary is reduced to 0. The owner's capital account is increased by the amount of the net income. So if you had net income, which meant that revenues were greater than expenses, and all your revenue accounts had credits in them, and in your closing entry you debited those accounts and credited income summary now has revenue on the credit side, and on expenses they usually have a debit balance, and to zero them out you had to credit. So you credit each and every expense account, making their balance 0, and you debit income summary account to transfer the balance of all the expenses into income summary. So right now income summary has revenues in the credit column and expenses in the debit column. So their net balance at this time would, if revenues were greater than expenses, you'd have a credit balance, which means that you would have net income. So net income should equal, in this account, should equal what you had in the income statement at this stage. If revenues were less than expenses, you'd have a net loss. So the income summary would be a debit balance because revenues would be less than your expenses, which would be the debits. So you'd have more debits than credits. So you have a loss. And that loss would be transferred to the capital account as well. So the income account summary, the income summary account is then reduced to zero. So in this situation, the net income amount of $33,667 is transferred to the owner's capital account, Carolyn Wells Capital, and that's increased by $33,667. Now the step 4 is to close the drawing account into capital. Withdrawals appear in the statement of owner's equity as a deduction from capital. And you know this to be true because when we ever had in Accounting 101, when there was Carolyn Wells decided to write a check for personal reasons, we would debit Carolyn Wells capital and credit cash. So the drawing account that we debited, we would debit Carolyn Wells drawing account, which is a capital. It would be part of the equity section. We debited Carolyn Wells drawing account, and that will have to be credited in the closing process and debit to the capital account directly. The drawing account is closed directly to the capital account. The drawing account balance is reduced to zero, and the balance of the drawing account, in this case $5,000, is transferred to the owner's capital account, reducing the balance. So let's see what this looks like. Here's your general journal, page 4, and the description is closing entries. Step 1 is to close the revenue account. We're going to debit fees income, $47,000, and credit income summary, $47,000. This debit essentially zeroes out the balance in the revenue account, and it puts the revenue on the credit side inside of income summary. The second step is close expense accounts. Let's work backwards. You're going to go to salaries expense, and you're going to see that it has a debit balance of $8,000. You're going to credit it to zero it out. The next expense is utilities. You're going to credit it $650 because it currently had, at the end of the year, $650 debit. So you're going to credit it $650. Supplies expense, you're going to credit $500. Rent expense, you're going to credit $4,000. And depreciation expense on equipment, you're going to credit $183. So these lines will be basically zeroing out each and every expense account. Then you just total up these credits, and then you're going to find that they total to $13,333, and that's what you're going to put into the income summary account. So this is the first time you've had a journal entry that was greater than 3 lines. We typically kept you in Accounting 101 into 2-line journal entries, and I believe in week 2 we had some extra credit at the bottom of that assignment, and both of those extra credits got you into a 3-line journal entry. This is an example of a 6-line journal entry. And now step 3 is to close the income summary account. And we're going to close the income summary by $33,667 debit in the account. And we're going to credit Carolyn Wells Capital. Where did we get this $33,667? Well, in the income summary, we credited $47,000 for revenue, and we debited $13,333 for expense. The net of these two is a net income, because revenues are greater than expenses, of net income of $33,667, and that's going directly into the Carolyn Wells Capital account. This number is also reported on the income statement as net income, the bottom line, and then the $33,667 is debited in the income summary account to zero out that account. This account, income summary, will have no more activity for another 365 days until the end of the next year. Then the fourth step is to close the drawing account. This is where Karen Wells wrote checks to herself so she can pay her personal bills. And that's when she did that, we debited drawing and we credited cash. So now we are crediting the drawing account for that same amount, except we're crediting it to zero out the drawing account, and we're putting that deduction to capital directly now into the capital account. Okay, so some extra notes. Closing is entered in the description column of the ledger accounts. The ending balances of the drawing, revenue, and expense accounts are now zero. So closing entries and the post-closing trial balance using accounting information. Now we're going to prepare a post-closing trial balance. And then we're going to interpret financial statements and review the steps in the accounting cycle. So what is the post-closing trial balance? I'm just checking, and no one is on here with me. So these lectures can be so much more interesting if I have someone to talk to, folks. Just a big hint. So when you can possibly pop on to the live lecture section, and in this course it would be at 11 Mountain Time on Mondays. Excuse me. So what is a post-closing trial balance? It is a report that is prepared to prove the equality of the total debits and credits after you completed the closing process. It verifies that each revenue account, each expense account, and the drawing accounts have zero balances. And this is what it looks like. Up until right here, it looks like the trial balance that you prepared in Accounting 101. But you will continue in Accounting 101 with revenue accounts and expense accounts, and the drawing account will have balances in them. And in Accounting 101, this was not called post-closing, it would just be called trial balance. But this is exactly the same thing as the trial balance after our closing entries have been posted to the general ledger. Because what is the balance of a revenue account? Zero. What is a balance in each of our expense accounts? 0, 0, 0, 0, and 0. And how about the drawing account? Does it have a balance now or not? No, it has a zero balance. So the only accounts that have balances in them are our asset accounts, our liabilities accounts, and Carolyn Wells Capital. And as you can see here, after we posted all of our closing entries to the general ledger and did a trial balance, the debits equaled $132,350, and the credits total $132,350. Carolyn Wells Capital account has a balance in that account of $128,667. If you would look at that account in detail, you would see that it had a credit in it from Accounting 101. It has a credit in it for Carolyn Wells investments in the account, in the business, $100,000. It has a credit in it for $33,667 because that was a net income that the company earned. And then she'd have a debit reducing the balance by $5,000 because she took $5,000 out. The net of those three numbers is $128,667. So this, to summarize, $128,667 is the impact, is the actual capital account, but it has the impact of the owner's investment plus net income minus drawing. So let's just look here. We have Wells Consulting Services partial balance sheet. So this is the assets. So we see cash identified and accounts receivable identified. And we have supplies and prepaid rent and equipment, that's accumulated depreciation, giving us total assets of $132,167. Now that's different than $132,350 because these are the debits from the assets really stop right here, don't they? They stop right before accounts payable. So you just can't say total debits in the trial balance are your total assets because you have a contra asset sitting over here in the credit column because of accumulated depreciation. Remember that this is a contra asset adjusting the balance of the $11,000 equipment. This is the cost of the equipment, the $11,000, and the $183 is how much we've taken off so far in depreciation. So now, what is the cash balance? It's $111,350. Question, how much do customers owe the business? How much have people promised to pay us? We sold to them. Remember, we do sales on credit. So in Accounting 101, we debited accounts receivable and we credited fees income for people who promised to pay us in the future. Well, how much do the customers owe the business? In this situation, it would be $5,000. Okay, now let's look at the balance sheet on the liabilities and owner's equity piece. How much does the business owe its suppliers? This is where we would purchase computer equipment or purchase supplies on account. That's where we debited supplies and credited accounts payable because we did it on credit. So our accounts payable shows how much we owe others. So people owe us $5,000 because we sold to them, and we owe others $3,500 because they sold to us. Very important concept and very important not to get it confused. So now let's look at the income statement. The question is, what is profit? Well, the income statement, let's back up. The income statement is, as you remember, fees income, $47,000, less all the expenses for the month of $13,333. Revenue minus $13,333 gets you $33,667. So the question becomes, what's the profit? What's my bottom line? $33,667 is what you profited. That was what your profit was for the month of December. So the flow of data through a simple accounting system. And this is a summary. Source documents are analyzed. Oops. That was the last slide. But let's go to it and we'll talk through it. That was a surprise. So source documents are analyzed. Then we journalize the entry. Then we post the entry to the general ledger. Then we create the worksheet. And then we do the financial statements. This basically closes out the whole process of the accounting system. That doesn't mean you're done with the Accounting 102 course, because we're going to be talking about other things. But for the accounting system, we have gone through the cycle. Now we have specialized areas to talk about for the rest of this course. So why don't we take a few minutes and actually look at the homework assignment. My mother always said patience is a virtue. Okay, week 1. Okay, let's just go over this. In week 1, you have the closing entries. This is the subject, closing entries and post-closing trial balance. So today completes the actual accounting system. What are we going to talk about for the next 3 weeks, you may be asking? So week 2 in this course, we talk about the special nature and special issues surrounding sales and accounts receivable and purchases and accounts payable. In week 3, we discuss the issues around receiving cash, making cash payments, and banking procedures. And week 4 is cash receipts, cash payments, and banking procedures visited a second time. So let's go to week 1. You get to introduce yourself. You have a discussion forum. The discussion forum, just to remind you, you have minimum of 3 posts a week. The initial post which is a one with 150 words in it, and it has the APA reference citings and your research in it. That is due by midnight Mountain Time on Wednesday each week. Then by Saturday midnight, you need to find another student's post and post a response to it. A proper response would not be, "Hey, good point." Perhaps it would be, "Hey, good point. I like the fact that you brought up this issue. In researching that issue, I want to share this video. I want to share this article with you. What do you think?" It reinforces your classmates' comments and posts. It adds material to the discussion, and then it moves the discussion forward. That's what we're looking for in a response post. And that's due, 2 of those are due by Saturday, midnight Mountain Time each week. So do not lose points on that, because if you're late to discussions, the party's over. And I think it's akin to going to a dinner party, and which is on Saturday night, and showing up Monday morning expecting someone to still be there. So don't show up to the party late, and participate when you're supposed to be participating to get those 60 points. Then we have a week 1 assignment and a week 1 assessment. You do have practice quizzes, so you can take these practice quizzes, I believe, pretty much unlimited before you take your assessment. Your assessment is worth 50 points this week, and your assignment is worth 120 points. So let's see what the assignment is really asking you to do. Okay, simply, we'll just have to read this. The last step of the accounting cycle is to perform the closing entries. Hey, we're experts in it now. You will need to close all the temporary accounts: revenue, expense, income summary, and drawing. Well, we can do this. We just discussed it and saw how it works. Okay, so begin by journalizing these closing entries, and then be sure to post to the general ledger. So we have this template to complete this assignment. There's a hint. To begin the closing process, use the balances in the general ledger. You'll see why in a minute. And then it just kind of tells you how to submit, which you already know how to submit. So let's download this assignment template for week 1. Here we go. Okay, this is everything we have. So let's see what we have here. We have a general journal and all these yellow areas. Let's see, we have one journal expected with 2 lines, one journal expected with more lines, another with 2, and another with 2. What do you think? I think the first one would be for, what do you think? revenue and income summary. And this looks like it's the spaces for the expenses. So it would be income summary and all the expense accounts. And this would be income summary and capital. And this would probably be what? Capital and drawing, just like we did in the homework. So we know kind of what we're supposed to do here in this first section. Where's the information? Well, where do you think the information is coming from? Remember the hint? The hint said something about looking at the accounts in the general ledger. Do you see the balances? Here we have J. Jones Capital. Are we at the top here? Yeah, we're at the top of the, they've only given us a partial ledger here. So they begin the ledger with J. Jones Capital, drawing, income summary account, fees income, rent expense, all the way through supplies expense. And do you notice that each one of these already have their balances in them? So that's a source of information that you need to basically do your journal entries. Once you do these entries, then we want you to post those entries to the ledger. So if you're going to be doing a credit to the drawing account up here, right there, if you're going to do a credit to the drawing account, then go ahead and post it right here. Credit the drawing account is this one. So we're going to credit this account and the balance would be probably 0 if you did it right. So everything in yellow, we expect something in. Okay? So that's your homework, and it's worth 120 points, and it's the end of the accounting cycle. Congratulations. Let's see. I'm going to go to let's work an example. I'm going to go to the Vital Source ebook. And in this course, we're going to be covering chapter 6, 7, 8, and 9, because we covered chapter 1, 2, 3, 4, and 5 in Accounting 101. So I'm going to go to chapter 6. Okay. Okay, so this is a problem. Taylor Family Farm Ledger. It's December 31st after the adjustments, but before the closing entries. And we're supposed to record the balance in the ledger accounts and then journalize the closing entries in general journal and use account number 399 for the income summary account. Then post the entries to the ledger. So what is the first entry? Do you remember? It's to close the revenue account into income summary. So account 101 through 142 are the assets. Account in the 200 range in this ledger are the accounts payable. 300 is the capital and drawing accounts. 400 is fees income, and it looks like 500s are expenses. So we're going to zero out fees income of $324,000. It currently is sitting with a credit of $324,000. So what would you do to zero out this account? I would make a journal entry to debit, just the opposite, but to debit fees income, $324,000, and credit account 399, income summary. It says use account number 399 for the income summary account for this particular problem. And by that, we just completed step 1. Step 2, here are all your expense accounts from 511 through 523. So those are 5 accounts, and those 5 accounts all have debit balances to them. So we know that we have to zero them out. So we're going to debit income summary for an unknown amount right now, and then credit advertising expense for $19,008 to zero out this debit. We're going to credit depreciation expense for $5,400. We're going to credit rent expense for $12,006. We're going to credit salaries expense for $68,004 and credit utilities expense for $21,006. The total of these 5 debits added together will be what we debit income summary. So income summary will be the debit, and it will be the total of these 5 accounts. And then we have a credit for each one of the individual 5 accounts. And the process would be basically to zero these out and put their total impact into income summary. So that's step 2. So after step 2 is done, income summary has revenue in the credit column and expenses, total expenses in the debit column. And we have a balance. It's either going to be revenues are greater than expenses and you have net income with a credit balance, or you have a credit balance of a debit balance indicating a net loss where debits are greater than credits. In either case, you do have a balance in the account, and that needs to be zeroed out in step 3. Also, step 1 and 2 have served to zero out all revenue and all expense accounts. So step 3 would be to zero out or close the income summary account into capital. So if your income summary had a credit balance, you would debit the balance and put the offset into the capital account directly. And then the last transaction would be, do you remember step 4? Let's see. We cleared out fees income. We cleared out the expense account, and both of those went into income summary. We cleared out income summary directly into the capital account, which leaves the drawing account, because every account from capital up in this ledger are permanent. They do not get zeroed out at the end of the year. So that just leaves a drawing account. It has a $21,600 debit. We're going to credit that account and debit capital. So at the end of the day, you might be wondering, why are we doing this? At the end of the day, the capital account is very easy to interpret. You have money going in from investments. You have a net income or a net loss, one number for the year, hitting the capital account. Income would be a credit, a loss would be a debit. And then you'd have a debit hitting that account for drawing account. So there's only three things that can happen to a capital account at this stage in accounting. The owner increases more investment. The owner takes money out as a draw, and the owner gets credit for the net income or the net loss for that business for the year. Nice, simple summary numbers going into the capital account. Can you imagine what the general ledger account list or the chart of accounts would look like for a company like General Electric, one of the largest companies in the world? They probably have more than 5 expense accounts, don't you think? So if you have a company that has 50 expense accounts and maybe 30 revenue accounts, it would be pretty messy to clear that out directly into the capital account without first being summarized in the income summary. So it's just to keep this whole exercise is to zero out the accounts. The use of the income summary account is to keep the summarized data going into the owner's capital so that it doesn't become a big mess. And that's very easy to evaluate. So with that, we're almost at the hour break, and I will say goodbye. Please remember, let me get there. Please remember that we do have support for you. I just showed you the textbook because that's where we were having that last example. So the textbook is always a great source. You have your live session, which I showed you earlier. So in this situation, and these can always change due to student demand or availability of faculty or the number of courses. But basically, today's Monday at 11, you have a 8 p.m. Tuesday. Wednesday, you have 11 a.m., 6 p.m., and Saturday, you have 11 a.m. So these are hosted by faculty. You also have, and I showed you earlier, you also have the mega course lecture videos. I suggest you watch those, and watch those before you go to the live faculty supported live sessions outside of the lecture session. At least bring some confusion into the session so we can fix that. It's very hard for us to fix not having done anything from your side. So please at least watch the videos. All the videos, this recording lecture, as well as the mega course video series. We talked about the textbook, and let's go to Shark. And if you go to the Success Center, I believe, yes. You can go to accounting, and I think here's the support that they have a specific person for accounting there. And there's a lot of support on Mondays from 3 hours in the afternoon and 4 more hours in the evening. On Tuesdays and Wednesdays, it's 11 hours from 10 a.m. to 11 p.m. Thursday is from 10 a.m. to 10 p.m., Friday from 9 to 11, and Saturday from 9 a.m. to midnight. Do not wait until Saturday to say, oh my gosh, my homework's done, my homework's due. And please, I implore you, Accounting 102, like 101, like you will find in any accounting course, is not one you can take in a marathon weekend. So please keep up with Accounting 102 for each week. Do every week assignment, do all of your daily checkpoints. Do not lose any points. Try your daily checkpoints each and every day. Get as many of those 5 points as possible. Participate in your discussion forum and be timely with it. And be timely with your homework assignments and stay involved. So with that being said, I will say goodbye and I'll see you in week 2. Bye.